Welcome back to another episode of Angel Insights brought to you by SyndicateRoom. This is a show that delves inside the world of angel investing to reveal the tips, tactics and strategies of some of the best early stage investors. And joining me today is Thatcher Bell. Now, Thatcher is a venture partner at Gotham Ventures, and Thatcher has spent more than a dozen years in the startup community as a venture capitalist and as an operator. So prior to joining Gotham, Thatcher was a senior analyst at North Hill Ventures, the venture capital affiliate of Capital One Financial. Before joining North Hill, Thatcher held business and corporate development roles at Open Pages, which was acquired by IBM, and Shark Tank. Now, if you love the show with Thatcher today and want to hear more, then you can head over to syndicateroom.com, where you can find a load more articles, podcasts, and resources. However, it's now time to hand over to Thatcher Bell, venture partner at Gotham Ventures. Thatcher, it's such a pleasure to have you on the show today. I'd love to get started, firstly, by thanking you for taking the time out to join me, so thank you for that.
Happy to. Thanks for having me on.
And then I'd love to now start by hearing about how you made your first foray into the investing world.
Sure. It was more or less by accident. I wasn't looking for a role in venture capital. This was now, I hate to admit it, but more than 15 years ago. I was connected to a partner at the time, actually, a principal at a firm called North Hill Ventures, which was at that time the venture capital investing arm of Capital One, the big credit card company.
Absolutely.
And I was connected to him by a mutual friend, a guy that I'd worked with before in consulting. They were at the time looking for an associate. I got on the phone not knowing much about North Hill and knowing very little about what venture capital even was, and was ultimately invited to join. Didn't take that opportunity right away. Instead, I actually went to a North Hill portfolio company. That was my first startup experience or experience in the startup world at all. And then ultimately ended up working indirectly with the director on the board of that company, who was from North Hill, working on an acquisition on behalf of the company. And ultimately did join North Hill maybe 14 months later, something like that. So that was how I got in. I heard about it as an industry first through an interview and fumbled my way into North Hill Ventures through a portfolio company.
I'm really intrigued. Why did you decide not to take it initially? Why did you want to have that startup experience? And do you think it's something that all potential entrants need to have going into the venture industry?
I was excited about the company that I was joining. I downplayed my prior experience a little bit. I'd had some brief experience with another startup. A good friend of mine with whom I'd worked before had already joined and was working pretty hard on me to come onto the team. And I was excited about it. And I saw myself at the time as someone who wanted to be in operating roles in startups and ultimately perhaps wanted to start my own company. In fact, when I ultimately joined North Hill, I thought, I'll do this, meaning venture capital, for a year or two. I'll learn what those guys on the other side of the table, meaning the investors, are thinking, and that'll make me a better entrepreneur down the road. And now, I hate to say it, more than 14 years later, I'm still on the investor side of the table. And you'd ask me as well, I guess I must like it. You'd ask me as well whether or not I thought everyone who became a venture investor needed that startup operating experience. My short answer is no. I know that may be somewhat controversial in certain circles, but I think there are really important characteristics that ideally an investor brings to the role that can be developed perhaps more easily through operating experience than through other kinds of experiences. It's important to be empathetic. It's important to understand the pressures that an entrepreneur feels. But I think that the role of professional investor, venture investor, is decidedly different. And I got to work with, for example, a guy named Jed Katz at North Hill Ventures, who had started a company called RentNet, which became Move.com, and had been a successful entrepreneur, in other words. And he's a close friend of mine now. I worked closely with him at DFJ Gotham Ventures. He made the transition, I think, very well. He's still a venture capitalist now in San Francisco at his own firm called Javelin Partners. But I saw him when he became a new VC, and we talked a fair amount about that transition. I think fundamentally it's a very different role, and it's not right for every entrepreneur or former entrepreneur. And I have worked with some other investors who came from different backgrounds who also made the transition to venture very successfully, and I think were really value added and successful investors monetarily, as Jed appears to be as well. So I think it's a very valuable kind of background to have for the right person who can make that transition, but it's not the only relevant background, and I don't think it should be a requisite.
What do you think are the kind of core components to making the transition successfully? Maybe in terms of mindset, maybe in terms of how you approach the learning process, but what's important to transition successfully between operator and investor, do you think?
So I'm happy to comment, but I'll caveat by saying I was only in operating roles for less than 3 years. So I'm probably not the ideal person to comment, but having observed Jed and others and had a bit of that experience myself, I'll say the following. I think going into the role, understanding that the position is a very different one with respect to the portfolio companies than the position of a manager, a CEO, a management team member at a company. I think just acknowledging on the way in that it's a new job. One of the challenges that I have seen a variety of former entrepreneurs face is a version of the agency problem, that they feel based on their experience that the management team of a company should take certain actions, or more to the point that they themselves, if only they could take certain actions, if they could offer the pitch during fundraising, if they could attempt to be the one selling a new potential hire, if they could be the one going in to sell the product in a closing meeting with a potential customer, then they could make it work. And that impulse has to be killed. And instead, a mentoring and guiding and consulting perspective and impulse needs to be developed. And, it's important also to have the perspective of managing a portfolio and not just one company, and understanding how to allocate one's time, given that there are many companies that might place demands on it at any given moment, both in the portfolio and those in the pipeline that need to be considered for new investment. So it's just a different profession. And I think I remember seeing, for example, Josh Koppelman speak a couple of years ago. I think it was at the Wharton Private Equity and Venture Capital Conference. And for all of his entrepreneurial experience, and he has, I have unbelievable respect for him both as an investor and as a founder and former CEO. He said that much of the value that he now brings to the table as a board member, he brings based on his experience as an investor. And part of his comment, I think, was based on the fact that it had been a while since he'd been in an operating role. But also, I think it speaks to the value of experience in the role of venture capitalist and the difference between that role and an operating role that he might make that kind of comment.
You mentioned time allocation there between the portfolio. I'm really intrigued to hear what your time allocation looks like now with regards to your day-to-day operations, and then how you split your time between portfolio companies.
Sure. So first, as a level set, like many people in the industry, I'm juggling a few different roles. My full-time role is as a partner at CoVenture. It's a pre-seed venture capital firm. We have our own engineers. We develop software and invest cash for equity. I am part of the time on Red Bear Angels, which is, I think, how we got connected, which is a Cornell alumni angel group, and have some, therefore, investing responsibilities in both. And in terms of time allocation between, let's say, the portfolio and pipeline, and let's call it everything else, it varies quite a bit. But I think that at this point, at CoVenture, which again is my full-time job, we have more than 20 portfolio companies. I want to say 24. We just made another new investment and are actively investing. And given that we have a fairly substantial portfolio, that means that more than half my time as a partner is at this point spent with the portfolio, maybe 50 to 60%. Something like another third, depending on the day or the week, is the pipeline, new investment opportunities. And then the balance is administrative or other. Any given day, that balance might look very different. But as a partner, and given my background, I tend to lean heavily on portfolio.
And with the actual portfolio itself there, we often hear different VCs have different time allocations to the companies that are doing very well, doing poorly, and then those that are in the middle of the road. Where in that segment do you find yourself spending most and least of your time?
it's a challenge. I think the somewhat impolitic way to say it that maybe others have said on the show is that the reality is that particularly for early stage investors, which we are, the majority of returns will be driven by a fairly small slice of the portfolio. In a portfolio of, call it 25 companies, it might just be 2 or 3 of them. Therefore, the logic goes that to the extent that you can identify those few companies, your time as an investor is best spent trying to help the winners win even bigger. So if Spock were a venture investor, he might spend all or 95% of his time with the 2 or 3 or 4 companies in his portfolio that appear to be obvious winners. There are 2 problems with that approach. One is that it's not always clear, and in fact, for an early stage investor, it's often relatively opaque which companies will be the quote-unquote winners for quite some time. And secondly, the companies that demand your attention are usually those that are having the most challenges. Rarely are the most successful companies, at least in the moment, those that are humming along, demanding the investor's time. And so the day-to-day reality is that I am proactively making time with and thinking about how to help those companies that are doing best in the portfolio and attempting to spend as much of my time doing that as I can while being responsive to all of our companies when they need our help or if we can be supportive in any way.
What happens with the ones that maybe aren't doing so well and they haven't reached product market fit and it's not going well? How do you communicate the realities of the business to the founder when it comes to extending runway, further follow-on funding? How do you communicate that it's not going to happen to the founder?
So what I've learned over time is to be empathetic, but to be very clear as early as possible. And so while I don't like laying out hard and fast milestones when I make a new investment, I think that things change too quickly to preordain at the outset of kind of the deployment of a new round of funding what exactly should be accomplished with that funding. I do try to be clear about my expectations with founders, with a management team when we're making a new investment, when that money is fresh. And ideally, in coming to a meeting of the minds with them about generally, what are we trying to accomplish with this money? Along the way, then, as they're investing that money and attempting to move the business forward, I try to be clear with them about how I think things are going and to make that a dialogue, to understand from them what their perspective is. And when it's clear that the business is going to need additional funding sometime in the foreseeable future, by that point, ideally, I've established with the team what I think, and they already have a sense for whether or not we're likely to put more money in. I'll be very direct about that when the subject of a new round of funding comes up. And sometimes that is awkward, but really critical if the founders or the management team is going to be successful in managing the business through challenging times.
In terms of the follow-on funding we mentioned there, how much of a role is that for you in terms of servicing your portfolio companies, in terms of connecting portfolio founders to follow-on funders? And how do you approach the aspects of working with those later stage financiers and working together to prevent kind of excessive dilution that's often the case with pre-seed and seed investors?
It's a critical role. We think of that as one of our significant sources of value add for our portfolio. Recently, we started making occasional follow-on investments in companies that are performing well, but we don't lead those investments. And so it's important. And for most of the last couple of years at CoVenture, we didn't participate in follow-on financings. And for Red Bear Angels, there's an individual by individual angel decision as to whether or not to follow on. And so it's critical for, in either case, for the organization to be supportive of companies in finding new investors, follow-on investors going forward. So I spend a lot of time maintaining, developing relationships with seed stage and Series A stage investors. I'm been fortunate to have been a venture capitalist and angel investor for some time. And so came into my role at CoVenture and at Red Bear having some good connections in the investor community. But it's important to maintain those and to, make good use of those relationships for our portfolio companies. And it's a big part of the job for sure.
What do you find are the big challenges in making the transition from that kind of first institutional check that you are as the pre-seed to making the seed and the Series A leap?
There are a couple. I think that the most important thing is to, particularly as the early stage, meaning pre-seed and seed investment markets have matured somewhat over the last 4 or 5 years. I think there's a more common understanding amongst investors about what to expect. It still varies, and each investor looks for certain things that may be unique to his or her investment thesis. But I think entrepreneurs are living day to day and hand to hand combat. And over the course of 6 months or a year or longer, having taken pre-seed financing, they feel viscerally, they see day to day that they're making incredible progress on the operations side, making mistakes, learning things, improving the product, ideally growing the user base, understanding who their users are fundamentally and what business they're in, what product they're selling. And all of that is really important. But to get them to pull back from that and see how they're doing relative to, let's say, the many hundreds of other companies, early stage companies that the seed and Series A investors might be looking at is a big part of the role, helping entrepreneurs to understand how to explain their story, their progress, their traction, their momentum in a way that stands out from the crowd and doesn't just recount the experience that entrepreneur has had in the context of the company itself.
Mm-hmm. Absolutely. And I'd love to dive into a quick fire round with you now. So I say a short statement and then you give me your immediate thoughts. How does that sound?
Let's try it.
So let's do your favorite blog or newsletter.
At the moment, 538. It's election season.
Let's do career highlight for you so far.
I'd say the entire experience of working with the single platform team when I was at DFJ Gotham. It was a short 22 months from initial seed investment to sale to Constant Contact. I count the founders of that company still among my closest or best friends in the industry, and everything about that experience was fun and fortunately worked out well.
Biggest mentor to you and how that came about?
Truth be told, my biggest mentor overall is probably my mother. She was a single parent and raised me, and I'm still learning a lot from her every day. I've been fortunate to have a lot of mentors, no one kind of mentor per se in the venture industry. If I had to name a couple people who I've learned a lot from and or try to emulate, I would name Howard Morgan, who it was recently announced is stepping down from day-to-day role at First Round Capital as a partner. But I've been fortunate to be a co-investor with him a couple times, and every interaction I learned something from him. And then I mentioned Jed Katz already, who now is at Javelin Venture Partners. We started at DFJ Gotham about the same time, but he started as a partner and I started as an associate. And as I mentioned, we've become friends, but I've learned a lot from him.
What was the biggest thing you learned from Howard Morgan, as we said, kind of titan of the industry and stepping down? So what was the biggest thing that you learned from him?
Howard is almost always the smartest or among the smartest, the most experienced, in many ways the most capable person in the room in any startup setting, board meeting or otherwise. But he doesn't have to, and really never does, throw that fact in your face. He'll make a comment or offer help when it's appropriate and relevant. And otherwise, he's patient and supportive and willing to listen in spite of all of his experience and everything he has to add at any given moment.
What's the biggest challenge you face day to day?
As I mentioned before, we both develop software with entrepreneurs and we invest cash. And it's the first time that I've worked in a business that does that. We're one of only a few that I know of that attempt it. And making the most of those two capabilities and getting our engineering and investment groups, if you will, to be as productive as possible together is a fun but significant challenge. We're inventing something new, if it, as it were, more or less every day.
Mm-hmm. And then let's do your most recent investment and why you said yes.
So the most recent investment that I'm sure we've disclosed at CoVenture is in a company called VidCode. They make software that teaches teenagers how to write software code, specifically JavaScript. And we actually just made a follow-on investment while they were in Y Combinator. They just graduated from YC's summer batch, and we invested in the company and invested again because we love the founders who have hands-on experience teaching teenagers to code and teaching themselves to do so, who are women, which I think is important because the biggest challenge for some time now in computer science education has been not only making it available broadly, but getting students, and particularly girls, interested in computer science, and they have experience to know firsthand how to do that. And they've shown the ability to do so directly through teachers, through co-curricular programs, and now through partnerships with companies like Snapchat. So a combination of mission, market size, traction, and the founders.
Well, Thatcher, I can't thank you enough for giving up the time today to be on the show. It's been such a pleasure to hear more about you and CoVenture, so extremely grateful to you for giving up the time.
Harry, it's been great to be on. Thank you for having me.
And I want to give a huge hand to Thatcher for giving up his time today to come on the show. I really do appreciate it. And to Megan at the Red Bear Angels for making the introduction to Thatcher today, without which the episode could not have happened. And if you love the show today and want to see more from Syndicate Room, you can head over to syndicateroom.com, where you can find a whole host more articles, podcasts, and resources on angel investing. And that's syndicateroom.com. As always, we so appreciate all your support and look very forward to seeing you next episode.